Well, we had South African bonds trade softer by midday today as they follow the rand weaker after the dollar strengthened across the board on those expectations of a U.S. interest rate hike this year. Still, investors are awaiting local data to be released tomorrow. That's CPI numbers and, of course, an interest rate decision by the South African Reserve Bank, which is bound to provide further market direction. Ahead of that, though, let's take stock of some of the activity that's been playing out with portfolio manager at Future Growth, Wikus Furstenberg. He joins us on the line. Thanks so much, Wikus, for your time today. So I picked up a morning note today saying that there was very little movement in local bond markets so far this week, with benign volumes and risk off sentiment dominating the market space. Give us your sense of what's played out today.
Hi, Alicia. Most certainly. I think the global risk off trade is still on. We see that mostly in rand. Local bonds actually fairly well behaved. It sort of drifted a bit higher over the day. But if you really look at the backdrop, one would have expected the market to be a bit more weaker than it actually sort of closed on the day.
We'll be getting into the local factors to consider in just a bit. But before we do, globally, markets now starting to factor in a U.S. rate hike this year, still after last week's hold on rates. Surely this has to become a moot point at some stage of the game, Wikus, because we all know it's coming sooner or later.
Yeah, Alicia, this must be the clearest telegraphed policy intention in the history of central banking. And honestly, we're getting to a point where it's hard to understand why the Fed doesn't really respond. I know the reasons, I mentioned the reasons, but it makes sense for the Fed to start moving on policy, start normalizing, even if they only do 12.5 basis points at a time. But we know what's happening in the US in terms of growth. We know what's happening in terms of inflation. If you ignore headline CPI, if you look at core CPI in the US, we're sitting at 1.8% year on year. So, and the labor market is much stronger. It's not there yet, but it's as strong as they can sort of wish for at the moment. And that's sort of like what they had in mind about a year and a half ago. And those are the targets, and we're there now.
Mm-hmm. Yeah. Do we know, though, what's happening over in China? Because that seems to be the big question right now, Wikus. But it's also gotten to a point where, one has got to wonder if markets are getting carried away in terms of what they're pricing in terms of a slowdown in the Chinese economy.
My take on that is that you should expect a slowdown in China's trend growth as it gets richer, right? How can you expect a growth rate of 10% plus, considering what has happened over the last few years? So my sense is that consensus is playing a belated catch-up with trends that have been in place for, a while already, including emerging market growth. Of late, you've seen sort of commentators jumping up and down about risks to emerging market growth. But quite frankly, emerging market growth has been slowing down over the last few years, and South Africa started a while back.
Absolutely. South Africa is illustrative of that. Just take a look at some of the data points that we've been receiving. Tomorrow, we're anticipating CPI numbers. Wikus, what are you pricing in that regard?
Well, the previous number obviously was sitting at 5% year on year. We sort of expect a number closer to 4.7%, so a slight dip in the year-on-year number. I think market consensus sits at 4.8%. But I think you should probably ignore that. One is obviously still looking at what's going to happen in Q1 of next year into 2016, and we still expect headline CPI to head higher to just above 6%.
As far as our own Reserve Bank is concerned, which way do you see the MPC swinging in terms of interest rates locally, Wikus?
I think in terms of the balanced outlook on things, they can't ignore growth. We all know that. I think consensus is expecting them not to do anything tomorrow. It's hard to disagree with that tomorrow. But I think going forward, I would take my cue from where we think potential GDP is for South Africa, which is probably somewhere between 2.5%, who knows. And if you think inflation is going to settle at around 6%, maybe a little bit lower the next few years, a repo rate currently at 6% should actually go to 8%. So I still think policy should be tightened going forward, but as a more SA-specific issue, and clearly they need to be considered in terms of how they implement that policy going forward.
Very quickly, Wikus, if you do see the MPC holding rates, do you see the rand swinging weaker here? Because surely a hold would be offering some kind of economic, some kind of support to economic growth in the country, and that's a good thing, even if it does come at the expense of our carry trade appeal.
Yeah, no, I would be really irritated with the currency weakening on the back of that. I understand the global risk aversion thing. I think the currency is undervalued on a purchasing power parity basis against the trade-weighted basket. Real, nominal, doesn't matter how you look at it. So I agree. I mean, I don't think the currency should weaken on the back of that. I mean, clearly it's in the price. Consensus expects that. And on top of that, we slightly ahead in terms of non-normally policy, and already hiked the repo rate by 100 basis points since the beginning of last year, and I think for the right reasons as well.
Well, let's leave it there, Wikus. Thanks so much for your time this evening. Wikus Furstenberg is Portfolio Manager at Future Growth.